Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Now that we are out of our food comas for the holiday season, we're going to get back down to business here with the Roundtable crew. And the issue in front of us today, too, as a matter of fact, the latest revision to the gross domestic product. What's up with that? And did we ever get that Santa Claus rally? They'll enlighten us. Editor-at-Large Steve Reitmeister, Zacks Research Director Shiraz Mian, and that top market technician himself, Kevin Matris. So I hope everybody had a happy holiday.
Sure did.
Looking forward to a good start to a new year. Let's talk about this gross domestic product, because that is, I think, the main story of the past few days here. Outside of the fact that retailers' sales were up and getting a little boost from the market, but we'll get into that. So the GDP was revised downward yet again to show a gain of just 2.2% from the original 3.5% growth rate reported for the 3 months ending in September. I'm just going to go right down the line here. I mean, I'm confused now. Is there really a recovery still going on?
Obviously, the answer is yes, but a lot more modest than we thought it was. And we started with, it was at 3.5% and then got revised down to 2.8%. And most people just thought it would be, that last revision is usually fairly minor. And getting taken down to 2.2% was quite a blow. And yet the market kind of shook that one off here again, which might be leading into the Santa Claus rally question, just of going up for no good reason. But yeah, there is recovery going on. It's just a lot more muted than we all thought it was.
So Shiraz, is there anything here in your view that can derail economic recovery?
Well, the surprise factor from the second reading on the third quarter GDP growth and the final reading was there. It was a surprise. Typically, as Steve mentioned, from the 2.8%, the expectation wasn't that we would get down to 2.2%. But once you dig deeper into the numbers, there's always something for the more optimistic bended folks like myself to see some good things in it. And that probably accounts for why the market kind of took it in the stride and didn't really dwell on it as the surprise element. And just to briefly touch on some of those positives. Number one, in my view, the inventory numbers were revised further down than we had seen in the second reading, and that's a good forward-looking number for the Q4 GDP number. And for those folks who are more watchful of the Fed and the monetary policy, a 2.2% quarterly growth rate is below the normal trend growth for the U.S. GDP, which typically is considered like around 2.5%. So when you have a 2.2% growth, it shows that the economy is growing. It shows that we are out of the recession, the worst recession as everybody describes it. But we are not where the Fed would start taking note and changing its stance for the monetary policy. So the inventory number was good. The fact that it pushes further down the road any tightening from the Fed is also positive for the market and the economy.
Commercial real estate also much weaker than people seem to anticipate. And maybe the one big surprise was lower estimates for spending on services than originally thought. But it didn't seem, Kevin, to dampen the spirit for the holiday shoppers, for the consumer, which everyone is concerned about because they're kind of in a fragile state right now. According to Spending Pulse, retail sales this holiday season had a gain of 3.6%.
Yeah, retail sales have picked up, and you're seeing a lot of demand in manufacturing as well. Getting to GDP, yeah, it was a little disappointing to see it go from 3.5 to 2.8 to 2.2. But what's interesting is that a lot of analysts are starting to think that lost extra point is actually going to show up in Q4's GDP. I've seen some analysts put GDP estimates for Q4 at as high as 5%.
Really?
But what I think is important isn't so much the number itself. I think what is important is to be able to see the GDP show steady improvement. And I think that everybody out there is believing Q4 is going to be better than Q3. And let's hope that we can see the same kind of trend happen in 2010. Excuse me. If you were to look at all of the different economic reports that we have seen over the last 9 months, Chicago PMI, you look at the Philadelphia Fed survey, leading indicators and all of this stuff. All of these reports have been showing a trend of improvement, and that, I believe, is great foreshadowing for what we're going to see for GDP. What Shiraz had said, too, talking about inventories going down, there is this long-awaited anticipation to see this rebuilding of inventories after a historic year-long drop. If you do finally see this inventory rebuilding, coupled with all of the growth that you're seeing overseas, because the overseas growth is going to help lift the U.S., I think you're going to see a significant rise in GDP. That, in turn, is going to help job growth, and that, in turn, will help fuel more GDP growth.
All right, let's shift gears here just a little bit now. Talk about that holiday rally, that Santa Claus rally that everybody looks forward to this time of year. You have a good definition, real simple definition for the Santa Claus rally. What is it?
The market goes up on light volume, and when we were talking about beforehand, Kevin kind of threw in and going up for no good reason,
okay,
which is another part of it. In other words, again, GDP got ratcheted down from 2.8% to 2.2%, which the market should have went down on that news, and yet it completely got shaken off. And the market, I think, was up that day.
That's right.
And then we had a couple more days of sunshine after that. So, yeah, that's your classic holiday, Santa Claus rally.
Okay, so you say we got one.
Absolutely.
Okay. Did we get one? Your view?
I would agree with the contention that Steve had. You basically see a positive movement in the market for no apparent reason. And we have been seeing that. Though I wouldn't call it no apparent reason, we have been seeing a plethora of reports on the market.
I was going to say, is that necessarily a good thing?
We like today's report that you mentioned, the holiday sales.
Mm-hmm.
Now, there could be naysayers saying that the comparison from last year is not really a good comparison. Last year was an unusually weak, but still we are seeing growth. Some people would say that we had an additional day in this holiday shopping season relative to last year. So positive numbers on the whole, the economy out, the job picture improving, the retail picture not as dismal as many of us had been anticipating. So on the whole, it should, and we are seeing that evidence in the market as well. It's a neutral to a positive tone in the market, and that probably accounts for the Santa Claus rally.
Okay, I got two yeses. Technicals confirmed, Kevin?
Yeah, I think so. You know, we did see an effortless 2% rise last week, so I guess you can attribute that to the Santa Claus rally. And you did see it break out of a consolidation range, but last week we talked about what we were going to see for 2010, and I said that we would see the Dow get to 11.8, and I still think that's the case. So I'm thinking that the Santa Claus rally has another 12 months to it.
All right. And we said it before, but I'll say it again. This is the last roundtable for 2009, and so all of us here, Steve, Shiraz, Kevin, and myself, wish all of you who look in weekly, follow us here every week, and we appreciate that, a very happy, healthy, and profitable 2010. We'll see you on the other side.